What's up, guys? It's Kairos with pnlrehab. And today I want to go over one concept that would have saved me literally tens of thousands of dollars early on in my career had I understood this concept. I've been short selling small caps for about 7 years now, and I've made most of my money off of doing so throughout my career. So I want to explain this one concept. And for the people that I teach, it's very important that you watch this video. And anybody who is trading small caps, I don't care if you're long or short, you need to watch this video. And it's very important. It will change the way that you address risk management on the short side, and it will also change the way that you hold your winners on the long side. So without further ado, let's get into it. So the concept I wanted to go over is what I like to call volatility expansion. This concept, if well understood, will prevent you as a short seller or you as a long to either, uh, you know, abiding by your stop loss as a short seller or always leaving some partials to run if you're long. So the concept is called volatility expansion. That's what I like to call it. It sounds a little bit like JJK's like domain expansion, but yeah, volatility expansion. So these small cap companies, it's well known that they have very small supply. Their market caps are very small. So of course, if a lot of money comes into the stock, it can make the stock move up very huge in a short amount of time. So, we see this with like 40, 50, 60, 70, 80% gappers overnight. They'll come out with some press release, some news, and the stock will move sharply overnight. Um, Typically, the strategy is to short when, after the move has exhausted itself, and you're looking at taking it back down because most of these companies are very terrible companies. Um, so I want to give a couple examples of what volatility expansion looks like. So from here we have 253, it closed, and overnight obviously they came out with some type of news. We see the volume coming in here and it's moving. And for some people they might be thinking, well, 250 to 450 is like 80% or so. So a lot of short sellers, they like to think that just because move has gone up a certain percentage, that it's automatically becomes a good short, which is not true. And we'll see why in a second. So we see 480 to 4. It's like a 20% pullback. You have some shorts that are probably in the money, even deeper, right? So they're thinking maybe this goes down all the way. Instead, you have one singular, these are 1 minute candles, by the way, just comes back. And, for anyone that didn't really take their loss here on the short side, they're pretty much getting steamrolled, right? From 4 to 7, almost a 2x from the bottom. Actually, it is a 2x from the bottom. So now we have a consolidation. So we had an uptrend, then we had a pullback, then we had a reclaim, consolidation, breakout, consolidation. These are things that you don't want to see as a short seller, by the way. You don't want to see these things where it's just like um, slowly, continuously moving down and then sharp move up, and then tight move at the highs, sharp move up. Because these short sellers are getting squeezed, these short sellers are getting squeezed. And then now we have a huge consolidation here between 640 and 760. We have a big move up and then a rejection with about 3 million of volume at a $7 price point. That is humongous. That's about $14 million being traded in that singular 1 minute candle. The amount of people who probably took short on this candle is a lot. So what ends up happening is you have all these shorts that are stuck here if they didn't take their losses, all these shorts that are stuck here if they didn't take their losses, all these shorts here if they didn't take their losses. And what you can kind of notice is like, okay, you have a range 480 to 360, right? It's about $1 range. Well, then once it starts moving up, it's moved up about like $3. And then you have another range of about like $1.30, $1.20. And then how much does it move up? This is a $6 move right here. And what ends up happening? We have another range. So we went from a $1 move here to a $3 move here to a $1.30 move here, to a $6 move here, into a like a $3 move here. And this is kind of what it ends up looking like. You have this huge consolidation for most of the day. A bunch of short sellers are probably trying to hit it here. A bunch of short sellers are probably trying to hit it here. And if it never drops, these short sellers are getting stacked on top of each other. You have short sellers here, short sellers here, short sellers here. You have short sellers here. And the higher it goes, the more they convince themselves like, oh, it's um, all these stocks, they always come back, right? Like they'll eventually bag longs, but in reality, they don't know that they're the reason. They themselves are adding to the reason why this thing is endlessly going up, you know. So the pattern is this is how volatility expansion works, okay? You have a range, you have a move up, and then you have a range. So we'll consider this to be a more broader range because this is like only a couple minutes, but this is quite literally 30 minutes of consolidation. You have about $1.50 of range here. $1.50 to $1.80 if you really take the high and low. But if you're taking the bulk of the price action here, it's about a dollar. So you have about $1 of price action consolidating. And then as soon as it breaks this consolidation, it moves to you know $6, $7 to the upside. That is volatility expansion. It's when you have price action that is normally consolidating within an area. And when it breaks that consolidation, it expands out way outside the scope of what it did before the price action prior. So we have, a dollar to $1.50 of price action here. We have about $2 of price action here. And then once it breaks this $2 of consolidation here, we have a $6 move to the upside. And then it has another like $3, um, about $3 of range here. And then what ends up happening when it actually, of course, this got rejected, a lot of shorts get piled in here, comes right back. And what ends up happening on the $3 consolidation? We have a $5 move up, $10, $11 move up. So it topped out after $11 after breaking this huge like $3 consolidation. So the pattern of volatility expansion is that you have a move up, the initial move up. If we look back, we have the initial move up, which for this case, it would be here. Then we have a consolidation. Then we have a extreme amount of volatility to the upside once it breaks the consolidation. That is volatility expansion. So if you ever think that not covering your short near the highs or just above the highs is a bad idea because you're afraid of getting top ticked, this is always something that could happen to anyone at any time, right? Of course, it's not every day we get a move from 6 to 24, but it can happen. And it can happen because of these mechanics of shorts believing that just because something's up at high enough, it needs to come down. Statistically, that is the case. But the reason why risk management is so important and what would have saved me so much money in my career is that these are 1 minute candles. These don't give you like an hour to think about it. They literally give you 3 minutes and you're down like 50, 60% on your position if you don't cut your loss within those 3 minutes. And God forbid if you add to your position on the way up, then like you add here or here or here, then you're just done, and you keep holding. And then now you're facing like the second part of the volatility expansion. And now you have an $11 move to think about, like, as opposed to, oh, I should have just taken my loss on a $2 or $3 move. Well, now you're holding into a $6 move and you don't take your loss into this $3 consolidation. Okay. Well, Let's see how you do with that $11 move, right? Now you're down not $3 per share or $6 per share, but now we're talking about, you know, 12 to $15 per share. This is how short sellers blow their accounts. This is how I blew my account. This is how I lost everything. And if I understood that this concept was real, that as price moves up more and more and more and more, um, the more it works in favor to the upside. So, the thought process of taking your loss at the very high, like you could have taken your loss here and it slams down, right? Like let's say you're short in this consolidation and it goes up and it slams down, you know, and you're thinking to yourself, well, I just, screwed over my position. Let me get back in. And a lot of shorts get back in here, comes back up. They refuse to cut, thinking like, oh, maybe it'll have some price action here, and then it just doesn't. This is the type of psychology that really screws with shorts and overtrade shorts that overtrade, oversize. They don't understand how aggressively and how quickly um, a stock can move up when it starts to get away from them. So in small caps, you really have to be careful. These are career-ending moves, and this is just one example. I can pull up two others right away right now, actually. So we'll look at INHD from 6-8. Yeah. So obviously, as you guys can see, it moved up. This wasn't a pre-market move. This was intraday. So there are a lot of short sellers intraday because, again, short sellers think that no matter how high something goes, the higher it goes, the more likely it is to drop. Again, statistically, that is the case. However, when you get too stubborn with the stock, so we'll see it here, right? We have some consolidation here on the initial pop, about 50 cents to a dollar of full size consolidation. And then it moves from 2 to 460. So we have a $2 move up. And then here we have another consolidation, about a dollar consolidation. And then where does it move? It moves $3 to the upside. And then we consolidate again, about $2 of consolidation. And then another $3 move up. And then another $2 consolidation. Huge pullback from 9 down to 5s. So a lot of short sellers might have made money here. But statistically, like short sellers will hold because the edge on the short side is to hold your short for as long as possible, assuming that longs are bagged. And look at this, if you don't cut your loss when the stock starts to act like it shouldn't, like this is obviously supposed to continue to go down. So if it comes back like this and you don't cut your short, now you're facing, okay, do I cut it here? It's up 100%. I'm down 100% on my position in 5 minutes. Do I cut it? And it's like, well, let's see what happens. Right now you're down much more than that. And it consolidates again. Well, maybe the short's here. 44, guys. 50, 60s. And it happens fast. If you're a short seller in small caps, these scenarios are obviously not impossible. They do happen. They have happened. 2x, 3x, 4x, 5x, and it happens within minutes. If you're not careful, you will and can blow your account. Yeah, you might make money for months and months and months and months and months doing it. But these type of moves should literally scare the living hell out of you. If you're not careful and you don't cut your short immediately, These types of moves will make you lose weeks, months of progress. I'm not saying you should be scared on every single pop, but if you have your stop loss at a specific area, your invalidation point, and you don't take it, you risk these type of moves happening to you. Always take your loss. Don't remove your stop loss. Don't remove your max loss. This is why risk management is important, especially if you're shorting, because while the edge is in your favor, it's a numbers game. For every one of these huge stocks that run to 60, right, there are 5 others that will top out at 460 and then just die back down to ones. It's a numbers game. Pick and choose your battles. All right. If you're a short seller, if you're learning from me, this is exactly the type of mindset you need. You don't need to win every day. You don't need to win on every stock. You don't need to win on every play. You just need to take your losses on the stocks that are moving against you and let profit ride on the positions where they're not. And if you're longing these things, you should understand that majority of these things do go down. That most of the time breakouts are terrible stop spots to buy. But every once in a blue moon, you'll catch a crazy move. If you sell into strength, do it with partials. You never know how high something might go. I can give you one more example from the 15th of this month. That was the same day. This wasn't even the day I wanted to show, but so this is the 15th. Kind of same story. We have a huge move up, pullback, consolidation, reclaim. If you don't cut your loss here, you risk what? Volatility expansion. This is what it looks like. Okay. You have a consolidation, you have a breakout. It refuses to go back down. Most of the time, it will go back down. Breakouts suck. I don't care who teaches it in small caps. Breakouts the win rate for longs are very small. They're designed like that because every now and then you'll catch moves like these. So if you're long bias, sell some here and then see if you can get that volatility expansion so you can really let the minority of your position pay you. And if you're short, you better take your loss. I'm telling you, you better take your loss. You'll give up weeks, you'll give up months of progress in one trade. It's not worth it. It'll affect your trading going forward. One mistake of not taking your loss will affect your trading going forward. It refuses to break down after having this crazy move. And then we have even more expansion from 7 to 15. And I think that's the top. Yeah. So this move literally went from $2 to fives and instantly came back to 850 within, again, these are 1 minute candles. They happen fast, they happen quick. Have your stop loss ready. If you don't take your loss on these types of moves, you will get destroyed. Your short selling career will end, especially if you don't have proper sizing, risk management. Position sizing is huge. Understanding your position size and how much you'll lose if a stock moves against you is by far the most important. The most important thing in trading is surviving, not winning every day. Okay? What's the point of winning every day if you just give it all back in one day? You don't need to win every day, right? So, yeah, and this happens within an hour, about an hour and a half. So, next time you think about removing a stop loss or potentially oversizing, these are the type of scenarios that can happen to you. It happens fast, it happens quick. Be careful out there. Be careful out there, guys. Risk management is key. Surviving is number one. You can't grow your account if you're knocked out of the game.